Yeah, so thank you. First of all, I really want to just thank Ewok and Marla just for giving us this opportunity. We're really excited to partner with Ewok. Feed the Hunger Fund in particular, our CEO is Patty Chang, and unfortunately she couldn't be here today, but she was born and raised here in Hawaii, in Manoa. She currently lives in California. And so when she started Feed the Hunger Fund, she really wanted to focus on microfinance. And in particular, in the beginning stages, she really focused on women entrepreneurs and people of color. And so to partner with Ewok, this is just kind of right up our alley. It seems like a very natural and good fit. So I just want to thank Marla and everyone at Ewok for just inviting us to have this opportunity to share with you guys. As she mentioned, in January, we did an overview on how to access capital. And so overviews are great, but when it comes down to it, when people are ready to apply for a loan, they really are just like, we want to get into the nitty gritty. So yes, okay, maybe I'm ready for capital. Now what? Now what do I do? And so that is really my role in Feed the Hunger Fund, is sort of helping people in that first start applying for the loan. So we're going to go over that today. And when we were thinking about the title of this webinar, we thought getting down to the nitty gritty or whatnot, but we finally came up with just show me the money and help us help you to get that money. So thanks for being here today. A little bit about Feed the Hunger Fund. I believe Erin has a slide. We are a very small nonprofit, and all the faces you see there are all of our staff and board members. So as I mentioned, we service Hawaii, so the whole state of Hawaii, including all neighbor islands, and we also service California. We service the Central Valley and Bay Area in California. And so every single one of these faces, we are comprised of, we have three staff members here in Hawaii, which is myself, Erin, and Eric Bowman, who lives on the Big Island, and he will be joining us for the next two webinars. And then we have some board members. You may recognize some faces there. And we also have two loan officers in California. And so we are a very small staff. We are a very small nonprofit organization that really, we are passionate about helping local small businesses and entrepreneurs in getting the capital that you need that you may not be able to get from a typical bank. So Erin, you can go into the next slide. Sorry, if you go back, Patty is the one in the middle. If you can see her, that's our CEO. Okay, next slide. So our mission at Feed the Hunger Fund is we work hand in hand with funders and borrowers to create a world where access to opportunity and capital feeds greater food equity, security, and sustainability. So as you may notice from our mission, our primary focus is food and agriculture. So small businesses that have a focus on food or agriculture, but we do lend to other people outside of the food and agriculture sector, depending on what the business is and what the need is. And as I mentioned, we are what you call a CDFI, which stands for Community Development Financial Institution. So we do give microloans. When I say microloans, it can range anywhere from 5,000 to the largest at around 250,000, although that's not as popular. Our average loan size is around 50,000. And we lend to those who don't typically qualify for traditional bank loans. And so I'm curious, for those of you in the call, if you don't mind sharing what your business is, or if you don't mind just putting it in the chat, we would just love to learn just what kind of businesses you guys own, what kind of businesses you have or whatnot. So just go ahead and type that in chat whenever you're ready, just so that we can learn a little bit more about you guys. What makes us different from a regular bank is that we really do work hand in hand with our borrowers. We give very personalized, I guess not hand-holding, but very personalized service. And once you get a loan too, we continue what we call technical assistance. which is just continuing to help you along with any kinds of needs your business has, whether it's by connecting you with other resources, with other people. And if you have special circumstances that come up, we really try to work with you to try and help your business grow. That is our ultimate goal, is to just help your business grow. So we never want to put anybody in a hard situation. But yeah, so that's the difference between us and a typical bank. And so now we're going to really get into it with Aaron, who is our senior loan officer, and he does all the underwriting for our loans, and he is extremely knowledgeable. He's going to shake his head, but he's very extremely knowledgeable about finances, and even just he was a business owner himself, and so he knows a lot, and he's been doing this for several years, so he definitely is very familiar with the loan process. And so I'm going to hand it over to Aaron.
Thank you, Shannon. Should have cut you off earlier. So what we're going to talk about is sort of debt. What is debt? What are the forms of debt that are typically available? And what do those sort of different structures mean for your business? I think later, the next seminar, webinar, we'll be talking about sort of the underwriting process. And then the third one is sort of the application process, most specifically as it relates to Feed the Hunger Fund. But I just wanted to start with getting us all on the same page of what we're talking about, which is debt. There's sort of three main categories of financing available. You can have debt financing, equity financing, or grant financing. Grants, it's free money, but it does require a lot of work. I don't know how many grant writers are on this call or have written grants and then had to write the report. So yes, it's free money. You don't have to give up equity in your company, and you don't have to pay it back like debt. But there are strings attached, and that won't really be covered today. So that's sort of the last I'll say about that. So debt financing involves the borrowing of money and the paying it back with interest. It's pretty standard. I think everybody's familiar with that has a credit card or a car or anything like that. It's different from equity in that there's no ownership given of the company. So that's always nice if you're not ready or willing to give up equity, or your company won't get a valuation that you would be happy with, meaning that you would have to give up too much equity. So debt financing is actually one of the most abundant forms of capital in the market. But a lot of businesses do struggle accessing it. So once you get that loan, you pay it back, your relationship with the lender is over for the most part versus equity, unless you don't want it to be. And so Feed the Hunger does we're happy to help pre-loan, post-loan, and making sure that your business is getting the assistance it needs. So what do I got here? It's a quick glossary of terms. This is kind of blah, but I'll just touch on some of the key ones first. APR gets mentioned a lot. So that's an annual percentage rate. It's the amount of interest you're charged annually. A balloon payment is if you have a monthly payment schedule that over the life of the term, there's still a balance left at the end, and that is called the balloon payment. The closing fees are an important thing to consider as well. Most lenders will charge a closing fee in addition to the interest that you will pay. And that is meant to help cover some of the loan closing costs and the underwriting fees, the underwriting costs. Collateral assets that can be used to secure a loan. Most lenders will seek some sort of collateral. So understanding what assets you have and what you're willing to pledge as collateral is important. Credit report, TransUnion, Equifax, and I always forget the third one. Anyway, those are places you can get a free credit report. It's a summary of your credit history. Most lenders will use that to determine how well you've performed as a borrower in the past. Debt consolidation is if you have a bunch of debt at a higher interest rate typically, and you borrow money at a lower interest rate to pay those off. That's something that can happen if you've perhaps used the wrong sort of debt for your business. And again, default, that's when the terms and conditions of the loan agreement are broken and the lender takes steps to recover the debt. The finance cost is the sum of all costs to borrow the money, and that will include the closing fees and the interest. Sometimes if your cash flow isn't sufficient to cover the monthly debt payment, or your personal risk or the business risk is perceived as too high, a lender will ask you to bring a guarantor on, and that's just somebody that says, if the borrower cannot pay the debt, I will pay the debt. And so that's another way to help ensure that you can access the capital you need. Secure debt is debt that is backed by collateral. Auto loan, mortgage are examples there. Variable rate is the last thing here I want to mention. That's everything we do is a fixed rate, and everything going forward is pretty much a fixed rate. A couple exceptions. A variable rate is this paid to usually sort of the federal funds rate, and will vary over time. It can be a lower rate compared to a fixed rate initially, but right now in this market, I don't know if you would want to take a variable rate, as all indications are that the rate is just going to go up. So that's that. We made it through that. I apologize, but I just wanted to make sure that we sort of had some understanding around some of the terms that will be used. Don't know if it'll get more exciting. So here we go. Types of debt. These are the main types of debt that are available in the market. As mentioned, there's a secured loan, an unsecured loan, long-term, short-term. The example there is factoring or invoice factoring. I'll talk about that later. These are usually like 30-day type or 60-day loans. A revolving loan is like a credit card. And predatory loans, I put payday there perhaps unfairly, although it is very easy for those short-term high interest loans to be misused, and we'll look at some of the math and costs associated with these as we move through. So what is good debt? Good debt helps to increase your net worth or helps to generate value. So examples of this are, increasing your operational efficiency by buying some equipment that can automate your process, or if you've got the demand there, but you need more supply inventory to meet that demand, it would be purchasing that inventory. Good debt also has terms that are aligned with your business, and we'll talk about that in a little bit too. So on the flip side, what is bad debt? Bad debt does not increase your net worth and is used for things that have no lasting value. So basically anything fun. You want to do a trip, you want to buy some nice shoes, or, whatever it is, those fun things are typically bad debt. And the terms are things that don't align with your business. It may be that the monthly payments are too high, or you need a longer term, and this bad debt isn't aligned. Right. So what does aligned debt look like? Perhaps it has an interest-only period to allow for your cash flow to build up. Let's say you just bought this equipment, but it takes you 6 months to install it. And then after 6 months, now you start to realize this increased cash flow. A 6-month interest-only period would allow for that to happen. Other things are adjusting the length of the term to match maybe the life of the asset, or to help you just get a smaller monthly payment. And a reasonable interest rate. You don't want to be rushed to take out debt that you can't really afford. So that's something that you want to make sure that you investigate. And lastly, have a lender that acts like a business partner with you. You want to make sure, because you are essentially going to business with your lender, and you want to make sure that they understand your business needs and are willing to work with you. So I would strongly encourage that whoever your lender is, that you make sure you maintain a good relationship with them, speak with them early and often. I know for our borrowers, when they might get into trouble, maybe sales are down, or COVID, things like that happen, and your cash flow is really constrained. The sooner that a borrower speaks with me, the easier it is for me to manage our terms and loans, and maybe make adjustments to allow for some, non-payment periods or a deferral period, versus just missing that payment and then the lender has to go and reach out to you. That's usually a harder conversation than if you're proactive about it. Although it is an awkward and uncomfortable situation for some folks, or everybody, I would encourage that sort of behavior with your lender. So, okay, here we're going to get into a little bit of the maybe some math and some charts that look a little busy here. But this is just a visual representation of two loans. Both are $50,000 loans, both with a 5-year term. Well, one with a 5.5-year term, one with a 5-year term, one with the both with the 4% APR, or the annual interest rate. And what the difference is, if you look right at the first 6 months of the one on the bottom, you see this interest only period. And so there's 6 months there of interest only payments that are $167 versus the chart above, where it's immediately you're paying the principal and interest of $920 a month. And so this would be an example of a loan where maybe you want to defer a little bit of these full payments out until your cash flow is up. It does have an impact. It's going to cost you more. It costs you essentially that 6 months of $167. So you can see the finance charge compared between the top and the bottom one. You know, the bottom one is more expensive, but perhaps you wouldn't have been able to stay afloat if you were just paying the $900 a month from the get-go. I would, you know, the other thing to consider is penalties for early payment or lack thereof. And I think that'll come up in this slide here, where we're looking at the same size of loan, but adjusting the term. So these are three $50,000 loans, all at a 4% fixed interest rate. But you can see that a short term, right, to pay off that $50,000 in 2 years, you're going to have higher monthly payments. And so you can see that there with the $2,171 monthly payments. Then if we move out to the right, where the same loan is spread out over 7 years, those monthly payments go down to, you know, $683. So if you're managing your cash flow and your business is only generating, let's say, $800 a month, for this $50,000 loan, you're going to need to seek out a 7-year term. But in the light blue column there, what we see is the cost of that loan, right? You're paying interest over a longer period. So a 2-year term is only costing you the $3,110, whereas that same loan over 7 years is now costing you $8,409. So there's a big difference there. But what I encourage folks to do, or, you know, at Feed the Hunger, what we can do is we give you a longer term, so you're paying that shorter monthly period. But since there's no penalties for early payment, you could come in at any time and pay down that principal balance, which would in effect reduce that finance cost that you're seeing there. So that's a tool to consider, and make sure you're talking to your lender about those sorts of options, you know, for early payment, if there's penalties for that, which would change the math now. So let me see. Well, I can pause there for a second if there's any questions. I don't know if anybody's on mute or in chat. I can keep going. Maybe Shandis or Marla can bring them up later. But so here's the skeptical baby here. So all interest rates are not created equally. That's the other thing, right? So we've got the term we talked about a little bit. We talked about some interest only periods. But everybody sort of does a little bit of a variation on the interest. And this goes back to the types of debt that were offered at the beginning. So term loans, they'll have a fixed or a variable interest rate. Short-term loans will often present their interest rate as a monthly number. So you got to make sure that you're actually looking at an annual or the APR if you're comparing a short-term loan to a long-term loan. And we'll look at that coming up as well. Credit cards can be great. That can be a great tool, but you just want to make sure that you're paying off the balance on the monthly basis or whenever that interest-free period is. Some have fees, some don't. So those are things to be aware of. Payday loans, they have a high monthly interest rate and fees. You know, so you got to really make sure that you're paying them back quickly. And those are really an emergency fund that should probably be avoided if possible. I think there's other ways, but I think if you're looking, you know, from a long-term loan to a payday loan, apart from the cost, the other variable to consider is the length of time it would take from application to cash in your bank, right? So going for a mortgage takes you a lot longer to get through that application process than it does to get a payday loan, right? They just, you're in and out. So and then the final one here on the bottom is invoice factoring. Some businesses use this. It can be a good tool. What it is let's say you've got a bunch of outstanding invoices that are like a net 60, so they're going to be paid off in 60 days. An invoice factoring lender will offer you some percentage of the value of those invoices, anywhere from 60 to 85% tends to be a good range. And then they charge you an interest, a fixed interest for that period, whether it's 30 days or 60 days. But then thereafter, every day it can escalate a certain percentage rate. And so here we are comparing exactly these things. So you can see sort of an apples to apples comparison. So this first example is on a $600 loan, small loan, but this is the maximum payday loan in Hawaii. And the maximum interest rate was crazy, 171% APR for a payday loan. Anyway, so what we see here is this is a 30-day loan. Invoice factoring is a 4.5% monthly. There's a bit of a range there, but 4.5 is sort of what's happening right now. That's a 54% APR rate. So you're going from a monthly interest to an APR. You can see the apples to apples there if you're looking at the other loans. It has that 0.05% increase in interest daily after 30 days and a 5% closing fee. A payday loan is the 14% monthly interest rate with a 15% closing fee. And so you can see that's costing you $176 to borrow $600, whereas the invoice factoring was only $66. And then moving to the right, we see a credit card here that, if you're paying that balance off, let's say you're a couple days late and then you pay it off, you're going to be charged that 1.5% monthly fee. But there's no closing fees. There might be an annual fee that I didn't include there, but lots of credit cards don't have annual fees. And then the term loan here, which is a 4% annual, but only a 0.3% monthly, but it has a 2% closing fee, which results in it costing a little more than the credit card. So in over the short term, if we're talking like 30 days, your credit card is not a bad tool. It's something that can be used, but you have to make sure that you can pay that balance off within the term. And it's even more true for invoice factoring and payday lending. But now this where it gets a little funner for the debt nerds is let's take this same loan and look over what do I got, 24 months. So here's what happens now that the same loan in the same terms, but now it's a 2-year period. That invoice factoring that was a 30-day term, all of those daily increases of now that $600 is costing you $5,264. So this is a bit of an extreme outlier, but you could see why you would be under a lot of pressure to make sure that type of debt got serviced and paid in full promptly. And you don't want to get in a situation where you haven't paid it off for this length of time. The payday lending, it's now cheaper because it doesn't have that daily increase, which is really tough to swallow. But it's still costing you $1,600 just to borrow $600. Your credit card, if you're paying that 1.5% on that $600 for 2 years, that's costing you $115. So it's becoming more expensive now to use your credit card if you're not clearing off the balance. And now we're looking at a term loan, a 2-year term loan, and you can see that this is where this tool excels and becomes much more of the preferred instrument for securing debt. It's costing you $37 over that 2 years to borrow $600. So I'll pause there. That was a lot of information. I don't know if we've got any questions popped up in the chat, and we can stare at my quizzical owl for a minute before I move on, drink some coffee.
I don't see any questions in the chat, but if have questions, feel free to unmute and ask them as well.
We had a couple of questions emailed to us, and this may not be the appropriate moment to ask them. You might cover it later, but I thought I'd throw them out early and you could answer them or work them in. But one question is a business plan absolutely needed to get funding?
That is a great question. I would say the short answer is yes. The longer answer is not always a complete business plan is necessary. The business plan indicates that you've done your homework, that you've looked at your business, and so your lender is looking at that. That's one thing that they want to see. If you're if you've been in a business that's been around doing the same thing for 5 or more years, having a business plan probably isn't as crucial as having your pro forma history and 5 years of financial data. That's probably going to speak more and be more important to a lender than a shiny business plan. Now, that being said, if you're switching the lines of business, your business is shifting from one product to something completely different, it's important to maybe present a business plan then. If it's just an expansion of the same thing, not so much. But what is important, whether you have a business plan or not, are some key projections and understanding of your financial statements. So really having profit and loss statement, a cash flow statement, and a balance sheet, those things are pretty critical. And having the assumptions that are underlying where your business is going. I think the key ones are understanding your revenue stream, both what are you charging folks, what are the volumes of product or services being sold, where are those customers, how are you accessing them, so a bit on the marketing side there, but it could just be a table, and then the expenses, so that you can demonstrate you really understand sort of the cost to run your business. I think that's an important aspect that needs to be put together and presented to a lender. So those are components of a business plan. It's not necessarily a full business plan, but it does help to inform your lender that you are knowledgeable and trustworthy in terms of the risk that they're willing to take.
And would you say those basic components are really what any lender would be looking to determine?
Yeah, well, so in terms of a long-term loan and a traditional business loan, yes. If we're looking at like a payday lender, they just want ID and a W-2 or a pay stub, right? So it's totally different there. That's not really a business loan. But yeah, any business lender is really going to want to see that information.
And then I had one other question here: how to access funding with poor credit?
Poor credit, yeah. So we help borrowers with poor credit. There's certain situations where maybe that poor credit needs a bit of work before we can do a loan. So there's services at credit counseling that somebody might get referred to. And it could be as simple as paying off some debt that you're capable of, getting an agreement with a creditor. If something's in arrears, right, that's typically why you have a poor credit history. Somebody's trying to foreclose on you and claim whatever it is that you owe them. Having an agreement in hand where you've reached out to them, here's a payment plan, that sort of thing. That said, also, like for student loans, if you ignore it long enough, it goes away. I'm not advocating that, but I think there's some legal issues there where if you make an agreement to pay a debt that they might have charged off, you got to wait for that 5 years or whatever to rolls around so that it gets wiped off. But generally, the good practice is to go speak to those creditors and have that in hand. So when you go speak to a lender, they can work with you to understand, okay, you're taking steps, you've taken action, you're moving forward, this is good. Getting to the underwriting process of poor credit, we really look at not just the number. I mean, that's something that goes into our underwriting and it gets ranked with other things, but just because you have a poor credit score doesn't mean something that you score higher and elsewhere won't balance that out. what we want to do is really understand why is that credit poor. Is it an emergency medical issue? Is it student loan debt? These are things that are more forgivable perhaps than, using bad debt, those things that were fun that this perhaps show poor management of finances versus, important life decisions that cost money that were unexpected. So hopefully my rambling caught that.
Thanks, Aaron.
Yeah.
Yeah, and there's actually a question in the chat saying, do we offer all of those loans? And what are the qualifications required for our company? And also, do we offer a line of credit? I'll let you answer that.
Yeah. So short answer, no, we don't offer all of those. We really only offer term loans, preferably secured, but it doesn't have to be. We do unsecured debt as well. We don't do a line of credit. Our funding sources for debt mandate that we do a certain product, and that product is these term loans with a fixed interest rate. So we are working to raise other capital and develop systems to provide a line of credit, but we're not there yet. I don't know, did that answer the question? Was there another question in there that I missed?
Yeah, it is. What is the qualifications required for our loan?
To qualify for a loan at Feed the Hunger Fund.
And that's our next webinar, I know, but maybe you can.
Yeah, I can touch on it real quickly. There's a geographical component. We only service the state of Hawaii, as Shannon mentioned earlier, as well as in California, the Central Valley and the Bay Area. Primarily, we're focused on BIPOC and low income. I think 60% of our borrowers need to meet that requirement. So that's really our focus. Doesn't have to be. And then the other area that we like to focus on, again, Shannon mentioned, is within the food system. Now, that is a broad range for whether you're a farmer to a processor or a restaurant. We've done software developers that were working on, agricultural software programs. But again, we also do. We've given a loan to a woman on Kauai that was trying to start up a pet crematory. So certainly not food related, or as one of our board members stated, that they hope it wasn't food system related. So we have some loans outside of that. They're typically mission aligned in our target demographic, if they're not within the food system.
I have a question. So if we're not within the food industry at all, what is the process of determining whether or not you folks can help my company or me?
Right. So the first thing is, are you in one of the geographical areas?
What do you mean?
Are you in Hawaii? Are you in Central Valley? Are you in?
I'm in Hawaii, yes.
You're in Hawaii, yes. Okay, so right there. And looking at you, you meet our demographic as a woman, and a person, not white person. So I think, yes, that you've hit our target market there. We would not say no at this point. The next gates would be, is your business a food system business or not? It's not. Okay, that's right.
Not
that's
at all
fine.
related to food at all.
Yeah. So that's okay. We could still continue moving forward. You've met that our target market already, so that's okay. Then it's the next hurdle, and I'll get into this in the next webinar, is what's called the debt service coverage ratio, which is really what is your ability to make that monthly payment. So let's say, you're looking for a loan of whatever size that has a monthly payment of $100. We would want to see that your net free cash flow available every month is $120. So that's that 1.2 is the debt service coverage ratio, or the implication is that you have a little 20% cash buffer every month in case something happens after you pay the debt. That's really a key to the underwriting process for us. I mean, we can share the loan application and have a follow-up conversation later to see how that looks for you. Yeah, okay.
Thank you.
No, my pleasure. Thanks for the question.
We had another question in the chat about would Naples, Florida meet the demographic area? And unfortunately, that is a no.
Yeah.
But I'm not sure, Aaron, if you know of other CDFIs or similar lenders.
I would maybe if that the person asking that question can send an email into us and we can have Eric respond. Eric's not here right now. He's perhaps a little more familiar with other CDFIs in other areas, geographies than I am.
I'm going to put my email. I know it's on your next slide, but I'll put my email in the chat, and you can, Marie, you can email me directly and I can connect you.
So what do I have here? Oh, so yeah. So what type of debt is right for you, right? Like that's the question that I was trying to help you ask the questions to figure out what type of debt is right for you, right? And really what it comes down to is what's your cash flow situation? What is your ability to service that debt currently? And where will you be in the future? Most underwriters are really just going to be looking at what is your current ability to pay and not looking at your projections. You know, like you can say, well, I'm going to make $1 million next year, so I can pay for this, no worries. But if last year you only made 20,000, that's the number they're going to be looking at for the most part. There's other mitigating things, like maybe you have a guarantor come on and there's their income can help offset other things. You know, there's other things, like maybe you've got a buyer that's willing to sign an offtake agreement, so there's that guaranteed income at some point. Those are ways to offset that, but knowing your cash flow, understanding what you're trying to accomplish with it. If you're buying a fixed asset, that piece of equipment is automatically, it's collateral, and so it becomes a somewhat less risky loan. That's like car loans are easier than some other unsecured debt. And lastly, I would say have an aligned lender, somebody that is willing to work with you. And it's sort of a trade-off between speed and trust, right? Like if you've got bad credit, a lot of these quick payday lenders, they don't really care. They just do a couple numbers. They don't know anything about what your business or what that is. They just, okay, are these boxes checked? Yes or no? And it's a binary thing, and you'll never hear from them again. You know, some of your credit unions, or if you've got relationships with some of the other local banks in your area that you have your business account with, you know, build a relationship with your folks there and really strengthen those relationships, because that'll make it easier for you, you know, in the long run. I think that was really you know, we're here to help. So there's our contact information there, but yeah, I don't know if I drank too much coffee and blew through that too quick or if but yeah, you can email me any questions, or, you know, you can hang around. We got more time and answer any questions.
I had one other question that came in through email, which is, can you use business funding to pay off personal debts accumulated due to business expenses?
So if you have the receipts, I think typically if it's on a personal credit card, most lenders might say no. But if you're able to demonstrate that you have the receipts and you can show that these assets went to a business use, we've done that before in Feed the Hunger. You just have to have your documentation to show, you know, how that was used. Yeah, a good question.
Thank you. Was there any other last questions for this part? Remember, this is a 3-part series, so I thought Aaron or Shandis could kind of give a preview for part 2.
Yeah, so understanding underwriting. If you thought this one was boring, wait till next week. There's, I want to say it's 9 or 10 sort of metrics that we use in our underwriting process, and I'll go through that and we can talk about it. It's not to say that every funder or lender uses the same metrics, but I think some of them will be very comparable across the board. We've talked about credit score. Yes, that's on one of our metrics, but it's not the be all end all. I think the most important one for us is I mentioned that debt service coverage ratio. or a global debt service coverage ratio, which includes not just your business's cash flow, but sort of household income. There's some, debt to asset or liabilities to asset ratios that indicate, how much cash you might have to pay off debt. Some other sort of qualitative ones that we look at are the amount of time and experience you have in the industry that you're borrowing money for, and how long you've been managing that business. So those are things sort of like operational risk metrics. I don't think I'm gonna have to give the presentation next week. Then rattle through them.
I actually think next week's presentation is Aaron Mason's board, but I think it's really interesting because a lot of times people, before they apply for the loan, they want to know, how will I be evaluated? What are my chances of getting this loan? So next week's webinar is really going to go over that. We're going to show you, Aaron's going to show you like a little bit of insight into how the loans are evaluated and what we're sort of looking at and all the things that you need to do. Sometimes people like to know ahead of time, like, okay, this is one area that I'm sort of weak in, so I need to, sort of work on that area before I get the loan. So I think next week, we really are getting into nitty gritty next week.
Yeah, I would stress that understanding your ability to pay that debt, that monthly debt, that's going to be the biggest thing. And being able to show that to a lender, that's ultimately what they're looking for.
I have one more question. You guys mentioned that you do help with the business plan. And I know you said that it's not as important and they don't always look or just totally look at the projections, but if we are working on projections, is that something that you folks help with as assisting with the business plan?
Yeah, we've got some resources online, and we can help provide some guidance on building that out. Yeah, absolutely.
Like a template or something.
Yeah, there's templates, and it's also understanding. I think when you start your business plan, you really want to understand, what is this tool for? Is it just for you to understand your business? In which case, it doesn't have to be fancy, and you want to probably focus on things like understanding your profit margins and optimizing that and doing sort of like a margin analysis. So for every unit of product or service sold, I generate this revenue, but I also have these expenses, and that really helps inform, your pricing structure and understanding, what you can and cannot do. Other things would be really important for a growing business is understanding the cash flow. So when you're building out your projections, you're going to see with a certain growth rate, you need a certain amount of cash, and that's going to indicate where you have to raise capital, whether it's debt or is your company in a position to raise equity, or sometimes grants. There's grants out there. We work with folks, but debt is the easiest and has the least what do you call that, hooks in it to make you do stuff.
And Sheena, if you want to email me, I have we have an online business resource portal that has a lot of things. So there is a business template on that portal that can walk you through the business plan, and it's also a template. So if you want to email that to me, I can email you a link to sign up for the business online portal. It's absolutely free and it's accessible 24/7.
Okay, thank you.
And that goes for anybody on the call as well, if you are needing that. Any other questions? Okay, I think.
Thank you so much. Appreciate everyone joining us for this first part of 3 parts. And like I promised, we're recording this webinar and we will send the link out to all of you. Part of our goal is to ensure that you have free resources to ask your questions. So Feed the Hunger Fund is an excellent partner. If you have questions about how do you prepare for lending with them, or in general, they're really generous about helping answer your questions. I did want to also point out that we have wonderful financial and business counselors that can also help you with your business plan development, or looking through, reviewing your financial documents, or even understanding them or helping to prepare that. So we have a link on our website. I put my email in chat. So anyone on this call, you do have resources that are accessible to you to do this preparation and strengthen your business. So thank you so much, Feed the Hunger Fund, Aaron and Shandis, and all of you for joining us today. Please email if we close this webinar now and you have other questions that pop into your head. We're happy to answer them. Thanks, everyone.
Everyone. Thank
Yeah.
you.
Bye.